Once upon a time, everybody lived happily ever after, and in between, there was Tradespotting. With this sunny video, today we're going to break down two sets of companies, Target versus Lowe in retail, and Intuit versus Palo Alto in software and cybersecurity. We're going to analyze their fundamentals, check out their valuations, look at their past earnings, and get some expectations for what might happen as they report this week. Along the way, I'll use clear and memorable metaphors to make the numbers easier to grasp and a simple structure to the video so that you can follow along and get all the useful insights. This week, retail faces challenges, tariffs and consumer habits. Target and Lowe's providing a useful comparison then of how these two forces play out. In software and cybersecurity, Intuit's steady growth contrasts with Palo Alto's higher volatility but faster revenue growth. So let's dive into these two company comparisons and see what takeaways we get for SPY and the select sectors this week. Target is expected to report a 19% decline in earnings per share, quite large, and will have a significant. There's only a 1% dip in sales. It's facing headwinds from slower consumer traffic, the imposition of Trump's tariffs, and some brand challenges. Lowe's, by contrast, expect a smaller EPS drop, still quite significant at 5.5%, with retail sales dripping. Lowe's, on the other hand, expect a smaller EPS drop of 5.5%, still quite significant, but their retail sales are down 2%, which is obviously larger. They benefit from ongoing demand for home improvement, which has a degree of resilience, even though we see a broader retail slump. If we imagine together Target and Lowe, they're like two marathon runners tied together by their shoelaces. Both of them struggle under these current economic headwinds, but Target, they've got a greater impact from tariffs and slower foot traffic. So consumer shifts having a bigger impact there, tariffs likewise. Lowe's is stronger and kept afloat by that steady demand for home repair. Target's sharper earnings decline signals vulnerability. Lowe's smaller drop suggests they've got a degree of resilience built in. This allows Lowe's to benefit from consumers who invest in their homes during periods of uncertainty. If you're deciding not to swap, like you're not going to buy up and sell out, then perhaps you're going to add to your own house to get the value there. And this is a very popular activity at this stage of the cycle. If you're looking for stability or new patio furniture, Lowe's might be the safer bet, but Target's challenges could also mean some opportunity if they address those underlying problems. Intuit versus Palo Alto Networks. This is stability meets growth. Intuit expect 10% earnings growth and 12% sales growth. Their forward price to earnings ratio is 33.95. That's higher than the industry average. And what this shows that investors have confidence in a steady recurring revenue from Intuit, and that's been the case for a long time. So they've managed to develop this reputation. It's valuable. It's reflected in the share price. Palo Alto, on the other hand, aiming for a 14.7% revenue growth with adjusted EPS of about 77 cents per share. Company has had mixed quarters recently, reflecting the volatility in the cybersecurity market. You might have noticed the recent reports about M&S here in the UK. Significant impact on their business and stock price going forward from the cyber attack recovering from the last couple of weeks. Intuit are Swiss watch, they're precise, they're reliable, and they're built for consistent performance. Palo Alto Networks is a high-tech solution navigating a storm. They are quick, innovative, but constantly buffered by market volatility and sector challenges. Its premium valuation is supported by a steady revenue stream, their tax and financial software constantly gaining traction and market share. Palo Alto offer higher growth potential long term, but comes with a degree of uncertainty in the short to medium term due to current macro conditions. I checked out all the analysts' ratings for the stocks covered in this video, and I can tell you that there's a degree of imbalance. Some people think strong buy, some people suggesting it's a strong sell. So we're waiting for those results to come out. We anticipate a degree of volatility on announcement, and that's opportunities that we can exploit in the chart. Analyst ratings can be very confusing to the new investor. They tend to skew optimistic, and depending on the analyst and the firm, they can have a different form of analysis or experience in that sector. There's only a degree of value that you can take from these snapshot figures. Independent systems that track estimate revisions and then rank stocks by their price performance subsequent to earnings might provide clear guidance if you're looking for info on these two stocks this week. Intuit's current ZACs rank 3, which is a hold, despite mostly strong buy recommendations from the analysts, and that highlights the importance of gaining multiple perspectives from these authoritative sources so that you can understand the methodology and the data and their presentation. In summary then, my expectations, retail in general has an impact on Target. They face a bigger earnings pressure than Lowe's because Lowe's benefit from that stable home improvement demand, even during a downturn in the buying and selling properties. In terms of software, and Intuit is so dependable, like that Swiss watch, that we can anticipate steady growth. Palo Alto, they're like a nimble, agile company despite their size, and they managed to take on this volatility in that sector very well and also present steady revenue growth, but come with a degree of risk. So we use these other analysts' rating not as gospel, but as a point of reference to inform our own thinking when it comes to the charts. Investing is always a question of balancing risk against reward, and so don't be like Target and Lowe's and tie yourself to these analysts' expectations like they tie their shoelaces together. With that rundown on the fundamentals, the data to anticipate in these calls in terms of earnings per share and what you're really looking for, continued revenue growth. Now you're armed with the fundamentals. You understand the narrative of this select sector, both in tech and consumer discretionary. You understand how these companies that we're comparing are linked together and how the results will then inform a broader understanding of the market. And you've got the data so that when the information is released, you can compare it to expectations. That'll give you a way of managing your risk on the charts, which we're going to look at now. We begin with Target on the daily time frame, where you can see we've already sketched up a trade. This was one that we did for Discord. You can see that prices have slipped into this buy zone, didn't quite get to the stop, and now we're approaching that 50 simple period moving average on the daily time frame. We've got a clear area to manage risk below. If this thing drops below 91.80, it'll test 86 and change. If that doesn't hold, it could drop even further. I wouldn't look to be in it below 91 until such times as we had positive signs. Whereas if you're already in a trade and can manage your stop at that area, then perhaps you're looking for prices to move to the top side with a rocky outcrop flash at 132. That's nearly a 30% rise in price. And managing that with a stop within a couple of percent allows you to benefit from potential volatility on earnings for Target. If you miss that or you're not interested in Target, it could inform the trade on Lowe's. Let's drop down though first on Target 4-hour time frame and see previous gap closes in at around 104. Degree of risk comes in there. 200 period moving average on the 4-hour also at a resistance line in at around 114. Dropping down to the 4-hour time frame where you can see looking left, the gap closes at 103 to 104. 200 period moving average at 114, and a golden pocket comes in where we find another gap closed at 118. So these areas, 103, 114, 118, areas to pay attention to for the potential change in risk profile on Target. But if you're looking for a long, those are the areas to manage risk around. Down to the hourly, just to judge the validity of this exact moment in time, you can see also potential gaps below. There's where price would head to immediately on bad earnings, with a 50 simple coming in at the bottom of that first gap, and then another area of danger in around 92. So this is why the 91 level is a strong area to manage your risk. The closer you get to your entry, the better in terms of the cost of the trade. Now, lows back up to the daily time frame. Put this in the context of price action recently. There has been a little bit of a dip, obviously, with lower highs and lower lows. They've challenged this horizontal level where previously found support, and now you're looking for a move to the top side with higher highs. Those higher highs start at 234. That's the price that we had on close on Friday. So if lows can manage to open strong, if targets results come out positive, then we can anticipate something similar for lows, because they've also got that inbuilt resilience. You might be looking for this thing to test the 200 period moving average at 247. With this particular trade, that gives you an area to manage risk in that you don't want to see price below 225. You do want to see price break 250, and you could follow that trade, making sure you never lose money if you take your stop to the increasingly higher lows that would be put in that potential evolving uptrend. It isn't one that I'd be looking for long-term targets on, because if you go to the weekly time frame, you can see it's already recently been putting in all-time highs, testing that 200 period moving average, which was a golden pocket retracement. You're hoping for consolidation, return to the trend, and to move into a blue sky breakout, which you'd be following with a profitable trade and able to manage that over time rather than panic about getting out of it. That's target in lows, and a good take on the consumer discretionary sector. If we go into tech, you can see that on the weekly, they also touched off the 200 period moving average. A lot of tech stocks did that recently. Come back now to test important horizontals towards all-time highs. Again, a little bit of price action, sideways movement here. Daily time frame, a flash at 643. Very dangerous when this thing currently at 670. If there's poor earnings results, you could anticipate 643 as your target. If you're looking for prices to move to the top side on positive news, 4-hour time frame might be providing more detail. You can see prior high in at around 700, $30 on where you're talking about the minute. That's 5% move just to demonstrate strength, which means that you're very much beholden to risk management at the point of entry, as opposed to the target you'd be looking for. To justify that risk reward, then you'd need to use your own edge and limit that then really tightly with regards to stop loss, to position yourself in a trade that will be going in your direction. So it's a risk management that involves the cost of the trade to you and soft targets for your initial conception, because price is already so close to in at around 700. And that's a very tight margin for error, so you're going to need to have a very tight stop, which is why you might then look to Palo Alto, who've had a very similar chart here, but if we go to the weekly time frame, it's a very strong uptrend. And that takes a degree of the risk away in the long term, but because of the greater volatility on intraday moves, it makes it harder to manage in terms of an entry. So you've got long-term topside targets and a strong upward trend here on Palo Alto, but you've got a higher degree of intraday volatility. The risk on execution is very high on both these stocks, but the targets and the nature of that trade might be different, which would mean that your methodology and approach might be different. If you want to talk more about that, hit me up on the paid side of Discord. This is weekly time frame. If we drop down to the daily and see that intraday volatility, it's very consistent volatility. Lower than important levels of support recently. 50 simple 100 period moving average on the daily time frame, and prices retracement here quite dramatic. Also looks like it's potentially rolling over. If you check the RSI, you can see it's getting increasingly lower highs on momentum, but these retracements into oversold, they quickly showing you that potential risk is on signal on any short trade, and opening up the opportunity for a long on every retracement in price as it gets so low on momentum, which speaks to the lack of strength behind those moves when price is pushing down. Does it happen again? It's happened very recently. If you're looking for positive earnings, it's unlikely to get there. If it's not so good, then we anticipate prices breaking down. First place to look to, that of real critical risk, is in at around, going to have to go lower here, 4-hour time frame, break and below 183, where you've got the 50 simple crossing the 200 period moving average. If price goes below that artifact, it could be testing down 173, 165, and then because it would be off the back of an important news event, you could see it easily push to 157, 144, where you've had 2-3 touches of support since price started this little oscillation to the top side. And that goes far back as 22nd of April 2024. No, yes, sometime around there. So a significant period of growth that could be eaten by a retracement at this point, and you saw something similar happen after Liberation Day. The question now is, how do these stocks break from that trend? The lows that were put in on Liberation Day, confirming those lows we saw last year, or the highs that price got to just on the announcement of Trump's presidency? So these are clear areas in the range for stocks that haven't yet managed to return to trend and start creating all-time highs or completely break down below those Liberation Day lows. So that's the technicals, the fundamentals, and the overall assessment for the week ahead with regards to those two stock comparisons. Let's now go to SPY. If we're looking for all-time highs, then we'll have seen recovery and bullish continuation. In order to get that, we'll need to see prices move up on the Magnificent Seven, driven by strong earnings and their resilience in the face of economic uncertainty. We haven't yet seen any ease from the Fed, so that pushes even greater emphasis on strong earnings. Positive moves there would reflect well for smaller caps, which might have an outsized move in terms of their own stock price, that on the smaller caps. So you're looking for strong moves on the top stocks because of earnings, that pulling up smaller caps, having an outsized impact on that section of the market. And that's where potentially the most opportunity is if you have a limited trading diet. On the 4-hour time frame, prices look strong, have recovered above a 50 simple and a 200 period moving average, which would meet each other as price returns to the previous all-time high. That is one of the areas we've been looking to. Or if it doesn't reach that, 5981, that's another 30 points on SPY. Break above that, you're looking for 6,100. That area I would definitely anticipate a little bit of resistance. There will be buy long trades closing, there will be shorts opening, volatility could increase, and your risk profile would significantly change. So I'd be looking to take profit on individual trades, different tickers other than SPY. To inform that SPY move, if we're anticipating it move to the top side, here's VIX. You can see it's come down, tested that important trend line, reached back to the $20 flash that we spoke about last week. So another really positive trade setup there. Yet price hasn't yet managed to recover the significant rejection move you saw on downtrend. Means that SPY is still resilient and could still keep going. And you've got a rough flash on VIX at 13. And that would be where you would find VIX if SPY was pushing to that 6,100. So it's very possible, but we'll keep an eye on VIX breaking back above 21. That's an important rundown across the markets. Also, just a quick heads up on Burberry. We talked about it last week, and it was a massive move. Even before earnings started, it started boosting up. That was a 25% move on the Burberry trade in the equivalent video last week, so a really good move. We also looked at Walmart, significant data there. So I hope you've seen the video if you're interested in target or lows. That is the overall take on the markets to benefit you going into this week, which is an exciting week. It used to be sell in May and walk away, but that doesn't look to be the case now because we've seen so much economic uncertainty in the lead up to this part of the year. Trump's presidency has been completely different from the way the market anticipated it being, and that leaves a massive opportunity in these stocks over the summer. Thank you very much for watching. If you want more crypto in your diet, check out Rocky Outcrop on YouTube. Of course, I'll be able to answer any of your questions on the Rocky Outcrop Discord. Links below.